Good morning, traders. A warm welcome to any newer attendees present, and also a friendly welcome to our regulars. Thanks so much for taking the time out of your busy schedules. It's good to be back with you guys again. With that, I trust sound and visuals are clear. If not, please do go ahead and let me know in the chat box. I'm just going to extend that so I can see it while I'm talking. Just bear with me. Okay. Hi, Carlos. Good to see you. So the topic of money management can appear quite dull to many traders. So I was not really expecting a huge turnout for this, but I've been surprised so far. As I've noticed over the years, many prefer to concentrate efforts on method development. Albeit still crucial, we must adopt a well-rounded skill set if we want to be traders. Taking on board risk management, risk and money management principles enables us to be successful, and more importantly, remain successful. I can assure you that anyone who says money management, or even risk management for that matter, is not important, does not really know what they're talking about. It is vital. I have to admit, when I first began trading, all I cared about was where to get in and out, and just enter whatever position size I felt like on the day. I felt money management, money or risk management techniques really were a waste of my time at that point, and could easily be applied later on, or that's what I thought. It's a huge mistake on my part, that was. In terms of a presentation recording, if you feel like you did not catch everything in the webinar, the webinar is recorded, so you can go through it at your leisure. Also, I'm more than happy to answer any questions you have live, either during the presentation or at the end. If I miss any questions or you want additional clarification, feel free to email the research team at marketsanalyst@fbmarkets.com. Just to be clear, recordings can be found on the FB Markets webpage or through our YouTube channel. Okay, onto the disclaimer. Look, the information contained in this material is intended for general advice only. It does not take into account your investment objectives, financial situation, or particular needs. FP Markets has made every effort to ensure the accuracy of the information as at the date of publication. Really, traders, to cut a long story short, what this means is I am not here to provide investment advice. This session is educational and should be taken as such. Topics for this session are reasonably simple. That is, we want to leave with a clearer understanding of money management. So really, just as a quick intro, money management is a strategy for increasing or decreasing the position size to limit risk while achieving the greatest growth possible from a trading account. We also want to walk away from here with some idea on the different money management strategies commonly used. And as for the Q&A session, as usual, I can take any questions I missed. I can take any questions during the presentation or any that I missed at the end. So let me kick this off by defining money management and who should apply money management principles. The second part of this question, who should this apply to, is quite simple. Every trader, whether you trade futures, options, currencies, or even traditional share dealing, you must make a money management decision before entering a trade. Trading is both an exciting venture with profits for the taking, but on the other side of the coin, it can be an endeavor that financially cripples some. For any newer traders present, trading is a business of risk versus reward, and proper money management takes this into account. Like most other competitive industries, the world of trading can be an unforgiving place, and I learned this firsthand. Basically, I was a trader void of the basic understanding. So, other than myself, who I am referring to here, well, offhand, I am talking about those traders who study trend lines for a week, for example, and believe they can trade. And for those with the get rich quick mentality, with this, failure is, dare I say it, almost certain. Not almost, it is certain. It's 100% certain. Look, I know what I'm saying may come across as maybe a little too straightforward or even harsh, but it is the truth. And anyone that tells you otherwise is either lying or has excuse me, or has no idea of what they're talking about. Either way, these people should, in my humble opinion, should be avoided at all costs with regards to trading. Now, as for a definition, I've heard many accomplished traders note that money and risk management are more important than the strategy you employ to navigate tradable opportunities. While I do agree with this, a method is still incredibly important. I've put a lot of effort into method development, so I believe it's on par with money management and risk management. But look, money management, don't underestimate this, that money management is a huge part of your trading business. So what is money management? Well, as its name implies, money management is simply the management of your money, your capital, or your account equity. And for the sake of clarity here, money management applies to every single trader, whether you trade an account of $500 US, $1,000 US, or even 10 million US dollars. Money management principles should be applied, and should be applied to both short-term trading and also long-term trading as well. There are, as I've said, there are a number of definitions circling the web, and I'm certainly not here to say that they are incorrect. I'm just going to put forward my views and experience, which will hopefully set a foundation for some of you here. Money management focuses on how much of your account equity will be at risk on the next trade. It looks at the entire or the whole account and applies mathematical formulas to let you know how much of the account you should risk. Proper money management never dictates where to get in or where to get out of markets. This is what your trading strategy is for, which will or should include trade management rules. Look, many definitions of money management include protective stop loss orders, which is a level at which your trying to think of the best way to see this. It's a level at which your trading method tells you to liquidate an unfavorable position. Even though the stop does have a connection with money management, it, as far as I see things, falls under the umbrella of risk management, or a risk management stop, if you will. It's also termed money management stop, as I've seen in many textbooks. The underlying idea is that you should, as I wrote here, don't bet the house, is you should never place all of your money on a single trade. This should be common sense, but rather put in an amount that is appropriate given the level of your risk profile. Otherwise, you risk losing everything. It's quite simple. Hence why money management is crucial. But the bottom line, as far as I see it, is money management should be in place to maximize return and minimize risk. Just plain and simple, consistent profits with minimum chance of losing all of one's capital. I believe this is termed risk of ruin. Because money management has so much to do with determining the size of the position, money management is also referred to as position sizing. By position size, I'm referring to the amount of capital committed to a trade, which is usually the difference between the entry and the protective stop loss order. But look, guys, although this is a presentation on money management, risk management is often linked with the practice. And this is why the application of protective stops is often termed alongside money management principles and also exit strategies. So I hope we're all following along nicely. As I said at the beginning, any questions, please feel free to ask away, and I'll do my best to answer. We have a comment here from Daniel. Never strain more than 1 to 2% of your account. Never risk more than 1 to 2% of your account. Yes, Daniel, I agree, which we'll come on to very, very shortly. Excuse me, guys. So let's shift things to what we're all here for, and that namely money management strategies. It might sound obvious, but the first rule of trading is to only risk the money you can afford to lose. Many traders, especially beginners, skip this rule. They assume that it won't happen to them. Yeah, I cannot emphasize enough how important that rule is. Just please do not risk any more money than you can afford to lose. This is key here, guys. This is a real key rule. Although simple, it should be adhered to. As you can see on the slide, we're going to now look at what's known as Martingale strategies. I'm pretty sure some of you here would have already heard of this. Just to be clear, I do not really support this kind of approach, largely because it can go very, very, very wrong in uninformed hands. But nonetheless, there are some who work with Martingale strategies and appear successful. The Martingale category simply states that as the value of an account is decreasing, the size of subsequent trades are increased by doubling the position size. The theory behind doubling the size of the bet is that eventually the losing streak has to come to an end. So one or two things will happen here. Either the streak will end and you make a profit, or you run out of money completely. The sound. All right, we're getting a comment from Lee. The sound is distorted. Guys, can you just let me know if the sound's coming across clear for everyone else? Just Y or N in the chat box would be great. All good? Thank you, Marcel. Okay, it seems to be coming across okay for everybody else. I'm not sure what's going on, Lee. It might be your side, I'm not sure. I'm going to try and move the mic away from my mouth maybe a little bit more. Ah, okay. Look, it's all good, I think, this side, Lee. Sorry about that. The sound is a bit metallic and disturbed. Okay, I'm not sure what I can do about that. I'm sorry. Look, if you can just bear with me, I don't really have time to change headsets right now. So if I can just continue and you can bear with it, I'd be most appreciative. Thank you, guys. Okay, thank you, Carlos. So, and let me just repeat this: the theory behind where was I? The Martingale strategy. So look, let me just repeat this: the Martingale strategy is yes, the Martingale is a class of betting. I'll get onto that in a minute. So the Martingale category, the strategy simply states that as the value of the account is decreasing, we simply double the bets. Every time we receive a loss, we double the bet. And the idea is that we, as I said, we will either the streak will end and we'll make a profit by our winning bet, or we'll run out of money completely. So that's basically your account ruined and you're wiped out. Unfortunately, this type of approach requires substantial capital behind it to weather the possibility of a lengthy losing streak. However, if the payoff ratio, now the payoff ratio is simply the ratio between gross profit and gross loss, is more than, the payoff ratio is the ratio of the average winning trade to the average losing trade, excuse me guys. And if that is more than 1 or 50%, then the Martingale money management approach could work in favor. Obviously, the higher the payoff ratio here, the better. Now, just to be clear, that the trending strategies tend to work with a higher payoff ratio. Trend following strategies tend to work with a higher payoff ratio. So just as a quick example, as you can see on the slide, if we begin risking $200 on a trade and employ a Martingale approach after a losing streak of only 5 trades, we are then down to $3,200 in terms of notional position size. While this may appear manageable for an account of say $50,000 with $10,000 with 10,000 consecutive losing trades, you will need a position size of more than $100,000. So as I hope you can see with this pyramid here that the obvious drawback here is the amount spent on trading this approach. And it can reach huge proportions after just a few transactions for the gain of simply $200. So in my opinion, it's not really worth it. This is just my opinion. I do know, as I said, I have seen some guys that say that they're successful with it, and some of you may be here too. I'm not sure. But actually, in fact, guys, if anyone here has had success with the Martingale approach, it'd be good to hear in the if you could let me know in the chat. Yes, the kid. The Martingale originated from 18th century France. I wasn't going to include that because I just really wanted to focus on the approach itself. But yes, it did originate from 18th century France. So of course, the flip side to a Martingale method is the anti-Martingale approach, or sometimes referred to as reverse Martingale. Now, and this is what many money management systems are essentially based off of. So as an account increases, the amount of at risk placed on future trades also increases. Winners are doubled until a goal is generally until a goal is reached. Therefore, it amplifies winning streaks. Yes, the kid. I remember we have a comment here. Yes, I remember the cold sweat after doing a Martingale. I have had no comments from anyone saying that they employ a Martingale strategy, so I assume most here do not. Okay, look, I hope you can see that by using an anti-Martingale approach, that success depends on having a larger number of runs in a profitable direction. Anti-Martingale is essentially where you increase your position size when you're winning and decrease your position size when you are losing. The perception is that the gambler, as this was invented by gamblers, will benefit from a winning streak, or as they may say, a hot hand, while reducing losses during a losing streak. So as an example on the slide here, if the starting bet was $100, a win gives another $100. We then bet that. We then bet $200, which is the initial win and the initial risk of $100. and assuming we get another win, this would then give us $400 US. Now, if a run of, I've used this example as many will use a run of 3 or maybe 4 consecutive wins before capping off their capping off their run, because if you continue trying to eke out as much as you can, eventually you are going to get a loss, and this will end very badly for you in terms of leaving so much profit on the table. Anyway, so now if a run of 3 trades was our cap, we would simply cut it off here and take our profits and begin fresh at $100 US. So if my math is on point, I believe that's a $300 gain in this scenario. If we get a loss during that process, on the previous slide, for example, we lose all gains. We lose all gains and, of course, the initial $100 risk. However, say at the beginning of our process, we did not get that winning trade, and it was $100 loss. We then, according to the rules, as far as I understand it, we halve the next bet, so $50 US. And if another loss, then only enter a quarter of the position, so $25 US. And on another loss, we enter $12.50, which is half of the quarter. As you can see, the bet size on a losing streak could actually become ridiculously small, to the point where we couldn't even reach. It'd be very, very difficult to reach back to break even. And this is why I believe many would likely put a cap, so a lower bound or a cap at say $50. So $100 is the default bet, and if we win, then 200, then 400, and so on. But if losing, then it becomes a loss of $100 US, and then 50 and 50 and 50 and 50 until a win comes along and we're back up to $100 US. As you can imagine, this is obviously the losing streak is obviously not a place not a pleasant position to be in, especially trading the Martingale strategy. Okay, as I'm sure you can imagine, there are a number of money management methods available, but given the time constraints of a single presentation, the objective here is to, 1, highlight the key money management methods, and 2, encourage you to further investigate money management following this and hopefully incorporate it in your trading. Now, I thought it would be best to kick off with a method known as fixed fractional, which I believe, and quote me if I'm wrong, was developed by Ralph Vince. Yes, it was developed by Ralph Vince, I remember. So look, if I had to sum up fixed fractional money management in only a sentence or two, it would be this: risk is kept at a consistent percentage while the account grows exponentially due to the inherent compounding, and contracts during drawdown to help preserve the remaining capital. As an anti-martingale technique, it is designed to accomplish the preservation of one's capital for as long as possible. Proper money management should address 2 basic topics, guys: risk and reward, which is what I believe the fixed fractional money management method does. So, the fixed fractional method states that for every trade, no more than a predetermined % of the account balance will be risked. So, as an example of this, let's say I have this is not this example one here, guys. I'm just trying to give you another example before I move on to this. So let's assume we have a $20,000 account, and I trade according to the fixed fractional method, or say 1%. So that is 20,000 multiplied by 0.01 or $200 US on any given trade. And from this, we need to work out our position sizing. This, as I said, as I said, increases increases lot size or contract size when winning, and reduces risk when losing. This is the hallmark of good position sizing and money management. So to help further demonstrate this, the example on the slide, we keep the risk, we're risking 2% on each trade and of the account equity, and targeting I believe it's a 1 to 3 risk reward ratio. And the account size is, as you can see, $50,000. So a 1 to 3 risk reward ratio not only helps, so we're risking 2% and following a 1 to 3 risk reward ratio, which not only grows the account exponentially due to the inherent compounding, but it helps contain risk when we're in a losing streak, reducing the amount on the table. This, as you'll see, is similar to a money management strategy named the 2% rule. So as you can see here, guys, we're consecutive wins. We jump from 50,000 on a win of 3,000. So it's a 1 to 3 risk reward ratio. 53,000, 56,000. Look, I'm not going to explain this all to you because I'm sure you can work it out yourselves. But this is a consecutive win. But on the consecutive losing side, 50,000, as our risk is set to 2%, we lose 1,000. And as the account gets smaller, our risk also contracts. This is the important part. As our risk contracts, we lose less. We're preserving our capital as we're in a losing streak, as any money management system should do. So look, in FX, it's important to recognize the currency market via what's known as currency pairs are traded in lots, or sometimes referred to as contracts, which essentially measures the transaction size of a trade. So when retail FX traders place orders, they use lots to notify the broker of the size they wish to trade. For those interested in position sizing techniques, and you should be if you want to be a trader, we do have videos for position sizing in FX in our education section. But to get the gist of it, let me take you through a quick example. Look, once we have the account balance, our account balance noted, the position risk set, and the currency pair that we're trading, and the stop loss distance measured, we can then calculate position size. Taking an example from our education section with an account denominated the same as the quote currency of a currency pair. So imagine a 10,000 pounds account, that's GBP account, with the trader willing to risk 2%. That's £200, 200 GBP of the account equity on each individual trade, as I said, which equates to 200 GBP. The currency pair traded in this case is a euro-pound. The distance from the entry to the protective stop loss order is, in this case, 30 pips. Knowing risk is 200 GBP, we must divide this amount by the stop distance, to find the account pip value. So we do this by 200 GBP divided by 30 pips, which gives us 6.6667 per pip. Next, we must multiply this by a set pip value for the euro-pound. Look, an account denominated in the same currency as the quote currency of the currency pair, that's the second currency in the currency pair quotation, which is GBP in this example, has pip values ranging from 10p, that's 0.10 GBP, for 1 micro lot or 1,000 GBP, £1 for 1 mini lot or 10,000 GBP, and £10, 10 GBP for 1 standard lot or £100,000 or GBP. So with that, we can multiply the 6.6667 GBP by 10,000 units, and that's one mini lot, which gives us 66,667 units, or GBP if you like. Now this is our notional position size, which in lots, is approximately seven mini lots. Look, as I said, please do go ahead and check out our educational videos. They're short, they're only 4 to 5 minutes, and this is what we go over in terms of position sizing with different account denominations and things like that. So it's definitely worth a visit, guys. In this example, if the trader increased risk parameters to say 4%, the account's pip value would be, I think it's 13.3333, and then dividing this value by 10,000 units gives, I think it's around 133,000 position size, which is, of course, one standard lot and approximately 3 mini lots. As I said, guys, please do go ahead and watch our educational videos on this. Look, I know I've diverged somewhat here with the position size calculation, so apologies for that, but I felt it was important to touch on as I'm sure most of us here do in fact trade FX. So I know I've clicked over to the fixed fractional money. Sorry, this is the correct slide. So look, if I take it back to the fixed fractional money management position for a few minutes, as there's additional information on this I just wanted to get across. Although most will be familiar with fixed fractional, with the fixed fractional approach I previously spoke about, another fixed fractional method of money management is, as far as I understand it, more applicable to futures. The calculation is the largest potential loss in dollars divided by the percent risk on a trade. So for example, if we are risking $1,000 US, we divide that by 10%, which is 0.10, and that gives us 10,000 US dollars. This basically tells us to trade one contract for every 10,000 US dollars in our account. Look, this is not something I would ever support or recommend, and I believe this is the reason why Ryan Jones, the inventor, the creator of the fixed ratio method of money management, which we'll touch on in a minute, designed his approach was to get away from this fixed fractional approach, which I've just mentioned. If you're interested in furthering your understanding regarding this, consider checking out Ralph Vince's work. So as I said, now we're on to the fixed ratio form of money management. This is an interesting approach, a money management approach developed by Ryan Jones, primarily for the futures and options market, I believe. He's also written a book called The Trading Game, if you're interested in furthering your understanding following this. It's definitely worth a read. It's quite a heavy read in terms of maths, but it's certainly worth a read in my opinion. So look, according to Jones, the fixed ratio method is a direct, as I said a minute ago, it's a direct result of researching and breaking down the fixed fractional method. I think, and I'm largely talking about the last method of fixed fractional money management I spoke about here, namely the amount of time it takes to begin using money management due to the large sum of money one contract has to have generated. This is what I was talking about a few seconds ago regarding the largest potential loss in dollars divided by the percent risk on a trade, which is something I wouldn't really support anyway. So look, the fixed ratio money management works with only one variable, and Ryan Jones refers to this as delta. And what the delta does is determine how aggressive or conservative the trader applies money management. So if we can try and remember this, guys, the lower the delta variable, the more aggressive your money management will be. Whereas the higher the delta variable, the more conservative our approach will be. The easiest way I found to think of delta is it simply stands for change. As you can imagine, the delta can seriously adjust the outcome of a method's return. So the fixed ratio calculation is, as you can see, the previous required equity plus the number of contracts multiplied by the delta value equals the next level in which the trader should increase contracts. Look, guys, this hopefully will become more clearer as we progress. So if we begin with an account of 10,000 US dollars, and the delta is set to 5,000 US dollars, we add, according to the calculation, we add 10,000 US dollars to 1, and that because that's how many contracts we're trading, to 1, multiplied by the delta, which is 5,000 in this case. So 1 multiplied by 5,000 is 5,000. Our equity is 10,000, so 10,000 plus 5,000 equals 15,000. So 15,000 US dollars account equity is required to increase by 1 contract. So you have to reach 50% of your account before you can increase your position size up to 2 contracts. Once we reach 15,000 US dollars, we then add this to we're then able to trade 2 contracts, as you can see here, or lots in this in terms of FX. So look, 15,000 is the previous required equity plus 2 contracts multiplied by the delta of 5,000. So the delta does not change. So 2 multiplied by 5,000 is 10,000. So 15,000 added to 10,000 is 25,000, and that's the next level in which the trader, as I said, should increase contracts. So we've increased the 2 contracts at 15,000. So 25,000. Once our account reaches 25,000, we can then increase to 3,000. Look, and finally, once our account reaches 25,000, we then add this, as I said, I think I've said this, 15,000. We then add 25,000 to 15,000, which is found by multiplying 3 contracts by the delta, which is 5,000, and this gives us a next level of 40,000 in which traders increase contracts. We have a question here. Please explain where the delta figure comes from. That's a really good question. The delta figure is, as I said at the beginning, is subjective to the trader. So it depends on how conservative or aggressive you want to be. As far as I understand it, it's up to the trader to select this. So for instance, as I've selected here, a 5,000 delta is quite a conservative approach. But if we look, the next slide should show this, but if we select a 2,000 delta for this, obviously our contracts will increase exponentially in comparison to a 5,000 delta. This is quite a complex and quite a tricky way of money management I've found. But yeah, let me continue. Hopefully this will make more sense. The kid, I think, asked me that. And yes, Daniel, this is a sort of compounding, for sure it is. Okay, let me just switch slides. So look, to help solidify our understanding, I thought it'd be good to go over a few example deltas. As you can see on the screen, we have a delta of 3,000 US dollars and a delta of 5,000 US dollars. As I just said, this is subjective to the trader. A 3,000 delta would be more of an aggressive money management approach, whereas a delta of 5,000 would be more of a conservative approach. So the first example is a delta set of 3,000 US dollars with an account, which I haven't labeled here, but it's an account of 10,000 US dollars. So knowing this and knowing the calculation on the previous slide is simply 10,000 plus 3,000. Remember, we're only trading 1 contract at this time. So it's one contract multiplied by the delta, which is 3,000. So it's 3,000, 10,000 plus 3,000 gives us an account target of 13,000. With that, so we require $13,000 in our account before we can move up in contracts. I hope you will see, you might have noticed that at 0.7, both of the delta 3,000 and the delta 5,000 obviously offer different account targets. So the 5K delta, also with an account of 10,000, is at 150,000 US dollars, while the 3K delta is at 94,000. Look, it will take much longer for you to reach your objective balance using a higher delta, hence why this is more of a conservative approach. Although this may seem amazing compared to the on 0.7 here, if you compare, but it will take much longer to reach 150,000 than it will do to reach 150,000 using a delta of 3,000. So look, I mean, for the first delta of 5,000, we require a $15,000 dollar account, which is 50% to go from one contract to two, whereas a delta of 3,000 only requires 30%. So look, of a delta of say 2,000, that would be 20%. 1,000 would be 10%. So the lower you go with the deltas, the more aggressive it becomes. So I hope that's, so look, theoretically, we could be trading, so just as a comparison again, theoretically, we could be trading with a delta of 3,000, 3 contracts by the time when the 5K delta is only on 2 contracts. So I hope you can see that once this gets going, this will really increase in speed exponentially. Look, as I hope you can see from this slide here, we can simply multiply the delta value. So again, this is the 3,000 or 5,000 in this case, delta value by the number of contracts to see how much we require to move up to the next level. Of course, this is not the same as the required account balance, the target account balance, I should say here. As an example, once we reached, say, just as an example, once we reached 85,000 on the delta of 5,000, that's the account target, using 5 contracts to reach 100 and, where's my cursor gone? To reach 115,000, we multiply 5,000, which is the delta, by 6 contracts, which is this area here, to give 30,000. So which obviously equates to 115,000, the next target balance. Now the question is, what do we do when a drawdown occurs? It's all well and good when the price is rallying in our favor. Most of us can make money in that environment. So look, a drawdown occurring could simply mean stepping back to the previous contract size and subsequent contracts if a drawdown persists. So let me just switch things up a little bit. So I'm kind of deviating from Ryan Jones's approach here a little to more of something that we might understand as traders. So look, on a winning trade, as you can see on this example, on a winning trade, we win 3,000 US dollars. On a losing trade, we lose 1,000 US dollars. So this is in terms of risk reward, this is a risk reward ratio of 1 to 3. So look, and the delta for this example is 5,000 with an account size of 50,000 again. So if I just take you through this, so the first trade we lose 1,000 US dollars, which is fine. Then we're down to 49,000. The next trade is a win, and as I just said, we're working on a 1 to 3 ratio, so we win 3,000. Our account's up to 52,000. The next trade is a win of 3,000, because remember, guys, we're still trading one contract here, or one lot in this case. let's keep it to contracts because this, as I said, this was designed for futures and options. So we win 3,000 and we're now up to 55,000. Now remember the delta is 5,000. So now as we've reached our delta value, we can now switch up to 2 contracts. So at this point, the next one, we have a loss. As we've switched up to 2 contracts, we now have a loss. So that's a loss of now 2,000 at this point here, because we're now trading 2 contracts. So a loss of 2,000 from 55,000 gives us 53K. Now with that, we're now back below the delta of 5,000. So this means we now have to go back to trading 1 contract again. So you see how it steps back. So by doing so, we have another win. Fortunately, we have another win. And this gives us 3,000, which brings our account back up to 56,000 and consequently above the delta value of 5,000. And following this, we have a win of using 2 contracts, which is 3,000 multiplied by 2 gives us 6,000. So as you can see, and then we have another win of 6,000 US dollars, which brings us up to 68,000. Now, at the next point, we are now at 3 contracts. As the calculation, if you remember, is 50,000 plus 15,000, which is 3 contracts. Where am I? Which is 3 contracts, which is 3 contracts, the number of contracts, and that's multiplied by our, where's my cursor? By our delta of 5,000. So we now are able at an account size of over 65,000 or 65,000 or greater, we're able to move up to a contract size of 3. But following this, we do get another loss another loss. And look, I'm sure you guys can work it out from this table. I hope you get the idea anyway. I know it's a bit complex, and personally for me, I do normally stick to the fixed fractional method of just the 2% rule or the 1% rule, depending on your account size. Okay, just to round things off, I thought it would be a good idea to also touch on a concept known as pyramiding or compounding a position. I'm sure most of you guys here do understand this or have heard of this before. Some view pyramiding as a means of concentrating their capital on those trades which have obviously shown more potential, should I say. Although many feel pyramiding falls under the umbrella of money management, Ryan Jones, the guy who we were just talking about, the fixed ratio method, does state that it is not money management because it does not look at the account as money management should look at the account as a whole, whereas pyramiding focuses on a particular trade. Okay, so look, I do understand where Jones is coming from on this, but as you will rarely see a pyramiding method that starts with 1 lot or 1 contract and adds 2 or more at one price level, and then 3 additional lots at or contracts at higher levels, and so on. Generally, if a pyramid is traded with, say, 10 lots at the beginning, each added position is generally smaller to form as the name implies, a pyramid. However, I still think it's viable. It's a viable mention here, as it can really boost returns if used correctly on individual trades. So as you can see on this example, the upper 2 offers a small amount of compounding from 10 contracts to add in 5. So the additions, as it says here, additional 5 contracts or lots, sorry, or 2 lots, 1 lot. Okay, and you can see the total position size ends at 18, from 10 to 18. The second 2 images are pretty self-explanatory, and they offer equal amounts of addition. So we start off at 2, start off at 10, and we add 10, and we add 10, and so forth. And so as we start off at 10, our total contract size or position size is 40. Contract size is 40. And finally, we have something called which some of you may not have heard, is a reflecting pyramid. But I'm sure with these diagrams you can understand where it's coming from. So we start off at 10 contracts. As price gained in favor, we add 5 contracts and then 2 contracts. But once we reach half of the expected profits, we then begin taking off some of our position. So we, as you can see, it's like a mirror image. So we remove 2 contracts, then we remove 5 contracts, and we remove 10 contracts. So these are just the different ways we can pyramid positions if and when the opportunity arises. Now, after that, let me just see if I've missed any questions. Peter, is there any calculation based on what you are talking about? I assume you're talking about the fixed ratio. The calculation is the previous required equity plus the number of contracts multiplied by the delta, and this gives you the next level in which the trader should increase contracts. That's the only calculation that I've found from his Ryan Jones in terms of calculating the with the delta and the levels you should increase. Another question is, what do I prefer? So look, I'm a fan of the basic fixed fractional method. As I think I already said, look, risk is kept consistent at a consistent percentage. I'm a big fan of that. I'm a big fan of keeping things very simple. So while the account grows exponentially due to the, as I've said, the inherent compounding, and you know, it protects me when I'm in a drawdown. And we all do go through drawdowns, guys. I know we all do. And so with the fixed fractional method, it contracts, and it contracts during the drawdown. This obviously, as I said, this really helps preserve remaining capital. Good books to recommend. So portfolio management formulas, I think it's titled, and that's written by Ralph Vinton. He's the inventor, I believe, behind the fixed fractional methods. So do give that a check out. There's also obviously the book by a guy named Ryan Jones called The Trading Game, and that comes highly recommended. As I think I've said, he is the guy behind the fixed fixed ratio method. Excuse me. Another question: how much of an account should I begin with? Oh, that's a tricky one. That's very subjective to the trader. How much of an account should you begin with? This really depends on your personal circumstances. I've seen many do start with 1,000 to 2,000 accounts. For me personally, I would always build it up in a logical manner. So if you've fully back tested the system and a method, and you're happy with it, then move up to a small live account of say $1,000 or £1,000. Then build slowly. So you become comfortable with the risk. So you become comfortable. So if you're risking 2% of £1,000, you're risking £20 every trade, and then if you're making money that way, if you can consistently build that account 10% or something, then you move up to say 5,000, and again you risk 2%. Okay, so your risk your risk profile is now £100. See how comfortable you feel with that. Get comfortable with that level. Get comfortable making trades at that risk level, and then move up, and just keep moving up until you're at an account size where you're very, very comfortable and you're making good returns. And then you can even lower the risk profile. So many big traders that I know trade hundreds of thousands of pounds in their account. They're actually trading a very low risk profile, much lower than 2%. They're trading 0.5% on most cases, because they just don't need to risk that much to make a good living. And any other questions? I'm just trying to look. You have not mentioned volatility-based factor for position sizing. I'm not sure what you're referring to with that. Maybe you could give me a few more points on that. I'm not sure. I know there's many money management methods. What I've shown you is just scratches the surface. Oh, in other words, don't just blindly apply a 1 to 2% rule. I do agree with that, actually. Don't blindly apply to a 1 to 2% rule, and I think that's what the fixed ratio method tries to address. But then I've use a volatility-based stop loss to then calculate the volatility-based. Yeah, I'm not sure. Not sure about that. I'm not sure what that is. I'll have to look into that. Look, I think that's all. Most of the questions, I think. Oh, you're very welcome. You're very welcome, Carlos. I'm glad you found it interesting. As I said, guys, look. Whoops. Sorry, guys. As I said, look, if there are any comments or feedback regarding this presentation, something you want me to improve, obviously the sound. I'm in the process of buying a headset, so let's leave that one. If there, as I said, if there are any comments or feedback on the presentation, or if there's any suggestions you want us to develop, please do send this across to market analyst, as you can see on the screen, market analyst at fpmarkets.com, or even the support team at support@fpmarkets.com. Also, do feel free to join our Telegram channel, which is active daily, and it shows daily updates from the company. So yes, I hope you've all found this beneficial, and it certainly gives you something to think about. I will catch up with you very, very soon. Okay, so yes, on that note, I'll bid you all a farewell, trade safe, and catch you all soon. See you later.